Well, good afternoon and welcome to the last session of today's conference on the GMO launch. So in the previous panels, we saw expected solar developments in some of the most interesting markets around the world. So we started off with China, we passed through India, then we reached Brazil. So we conclude today's overview moving from Latin America up to North America to gain some insights on the US solar market. So today I'm really glad to have with us Ravi Manghani, who's head of solar at Wood Mackenzie, who will share with us some insights about the current status and the future outlook of the US solar market. We will have the opportunity to discuss together a little at the end of the presentation, and therefore I invite you to post questions in the chat box that you can find on the right-hand side of your screen, and I will try to address them. I don't want to steal more time from the presentation, so without further ado, please, Ravi, I leave you the floor, and you can start with your presentation. Thank you.
Thank you, Rafael, and thank you, folks, to invite me to speak on this session. I work for Wood Mackenzie. I'm as Rafael mentioned, I'm the head of solar research at Wood Mac. Came into the organization through the GDM acquisition, and GDM also, as you may know, hosts some energy events. And I've always been intrigued that at almost all GDM events that I've been part of, I end up being the closer for the day. So I'm glad that the trend continues with this event as well. So again, thanks to folks who have stayed back late in the afternoon in Europe to attend this session. I will be talking about the US market outlook. What are the future drivers for growth? As I mentioned, I work at Wood Mackenzie. Wood Mackenzie is a sort of end-to-end commodities and energy market analytics and consulting company. We do provide commercial insight, data analytics to our clients in areas of metals, energy, and renewables research. Wood Mackenzie acquired, as I mentioned, GDM a few years back, and then more recently Make Consulting from our house, Denmark, and then just last year, Genscape. So the acquisition of the three organizations makes us, one of the leaders in renewables, EV, solar, renewables including solar, wind, EV, and grid-connected storage. We have over a team of 500 dedicated analysts and consultants spread across multiple geographies, pretty much all continents covered. And as you can see on the chart, all the yellow dots are where we have analysts focusing on the power and renewable space, which is what I represent as part of solar. So talking about the US market outlook, I'm sure it's been the theme for the past couple of days, but it's hard to talk about solar outlook without talking about what's going on globally with respect to the COVID-19 pandemic and its direct implications for solar, but also broader energy markets. So we'll kick off with that on that sort of sober note. But then moving past, we look at what does the market look like past 2020? What are some of the key drivers? What are the key fundamentals? The key headline here, as you can see on the slide itself, is that we believe that the fundamentals for solar and the key drivers still remain strong. Which means that if once we are past the COVID-19 lockdown and related economic slowdown, I think we do fundamentally believe that solar has a pretty bright spot in the energy mix. And then finally, as the title of the presentation suggests, I'm going to leave you all with our US 5-year outlook. So let's quickly jump on to what's going on in this weird little world of COVID-19 in terms of what it means for solar. When the pandemic first started in the US, it was limited to some of the states on the West Coast, as well as then in New York and some of the adjacent states, right? So back in March, when we were looking at what would the impact of COVID-19 be on US residential solar, we did a couple of different scenarios. A best case scenario that assumed that the pandemic itself would be short-lived. It would only impact 8 to 10 key states, and once we will be past that, the residential market would continue back on its track. And then, of course, we also did a worst case scenario where we assumed that the pandemic is going to last a little bit longer, most of 2020, if not beyond, and then it would spread to other states more than just California, New York, Massachusetts, New Jersey, which were the first few states that key residential market states that were impacted by the pandemic. Now, as we sit back, having the privilege of seeing how the lockdown effects have impacted both the spread of the virus as well as the response by the residential solar industry to the shelter-in-place orders that were effectively put in multiple states. So Q1 actually for us in the U.S. market started off with some sort of a record-breaking spree where the Q1 installations were pretty much tied with what we saw in terms of residential solar installations in Q4 2019. It's very rare that you would get two back-to-back big quarters, over 800 megawatts installed in each quarter, particularly in the light of the fact that we started to see some lockdown effect in the middle of March or middle to end of March, which effectively did put some stop to what otherwise would have been a great Q1 for US solar installations. Now, we do expect that the growth in Q2 will be severely hampered, particularly in states that have introduced very severe stay-at-home orders since the middle of March. As I mentioned earlier, those states have been California, New York, Massachusetts, New Jersey, to name a few. And why these states are important is because these are also traditionally fairly strong residential solar markets. And as you would expect that with any kind of lockdown, it's had an immediate impact on pretty much the entire value chain in the residential solar side, all the way from door-to-door sales to financing, even permitting and installation, where obviously we couldn't have installers go into homes where people would not want strangers to come inside their house and work, and likewise a lot of the permitting agencies as well as electric utilities were in a lockdown mode, so we couldn't see any kind of permitting or interconnection applications go through. Now, as some of the lockdown efforts have started to wind down, we did notice a bright spot again. That one of the key positives, in my opinion, of this pandemic is that a lot of the major US solar installers, particularly the national and the major regional installers, quickly moved to virtual platforms. They started to do digital site visits. Even some of the AHJs have incorporated virtual means of approving interconnection or permitting applications. So in general, we have seen some uptake in actual solar customer acquisition, as well as starting to see some uptake in installation processes and interconnection processes as well. So as a result of that, where we stand today, we actually do believe that the post-COVID impact of on the residential solar market is going to be somewhere in the middle of that best and worst case scenario. It's still about a 900 megawatt decline versus a previous view of 3.1 gigawatts to now, over a little over 2.1 gigawatts. But it's still reassuring in some ways that the market is dodged a bullet from the worst case scenario. Now, as you can see on the screen, that the first order effects will obviously impact the Q2 volumes, but there is a big sort of overhang that could actually go past the second quarter, and that's in form of the economic growth or rather lack thereof, given the lockdown and related unemployment issues. So if the economic growth slows down further and is more widespread, we do anticipate that unemployment rates or lower GDP growth or negative GDP growth, I should say, could in fact subdue consumer spending, and it also has implications on financing of these assets, particularly if we think about third-party finance or third-party owned assets. Moving from residential to non-residential segment, the story here is very similar. The only sort of distinction here being that a lot of the things that we've talked about have impacted the CNI space just as much. But on the flip side, the impact could actually go past 2020 and also into 2021, especially as a lot of the large CNI projects typically have life cycles or project development cycles that pan over multiple years. So as you can imagine, projects that were in very early stages of development had to sort of come to a screeching halt. But at the same time, in a lot of geographies, in like states like New York, where there were, and Massachusetts, where there was a complete pause on any kind of construction, let alone solar construction. So the result of the slowdown in construction is effectively pushing out some of the timelines for those late stage development or under construction projects to later in the year and perhaps bleed into 2021. And on the other hand, the slowdown in project origination and early stage project development could actually impact what happens to the overall growth trajectory to CNI segment. The chart on the left again shows a very similar thinking that we had at the onset of the COVID-19 pandemic, where we again expected as much as 1 gigawatt drop in 2020 installations for the CNI segment. Now, again, sitting here in June, some of that downside is not playing out to the same extent as we had anticipated, particularly as some of the larger states have started to again allow construction to continue. So we do expect that we are going to end up 2020 at little over 1.3 gigawatts of non-residential installations. One thing to again keep in mind is, as you can see on the last bullet, is in addition to the project delays, there is definitely going to be a huge impact of any kind of GDP contraction, because GDP contraction would result into lower business expenditure, and for a lot of businesses, especially the small and medium-sized businesses, investing into solar, it may not be the highest priority item once they do get back to any kind of normalcy. And then the other sort of ripple effect as a result of the lockdown is for a lot of these CNI customers, their energy spend actually has shrunk because of the lockdown. They haven't been operating machinery or any kind of heavy equipment to the same extent as they would have prior to the lockdown. And that does actually reduce the energy spend, and a reduction in energy spend would mean that there is a lower incentive or lesser incentive, I should say, for them to install solar. So we are already seeing some some direct impact on origination efforts from some of the CNI developers, which again is going to result into demand that's lost both in 2020, but also some of it being lost in 2021. Lastly, moving on to the utility scale segment, again, a very similar story where we think about the impact in terms of waves. Obviously, if we go back and think about the residential segment, these three waves are fairly, sort of congested, or I should say compacted within a few weeks period. Whereas in the CNI segment, these three waves can be thought about, lasting anywhere from 6 months to 2 years. But if you think about what it could mean for the utility scale segment, these waves actually are going to have direct implication for utility scale demand going as far out to 2025. So if you think about what's happened so far, when we first started to look at the COVID pandemic spread in China, the first concern in the industry was supply chain disruption. And we saw some supply chain disruption in form of delays, port closures. But then, since China came back into more or less full operation mode, some of the supply chain concerns took a backseat, and we clearly knew that we were entering into a more demand-constrained environment where delays in project development or origination, and even in some instances, actual site construction delays would actually result in missing milestones. And I'm sure a lot of you are aware that the next couple of years are critical as it relates to the investment tax credit step down. So any kind of investment tax credit step down, and tying that to delays in actual project development has huge implications on some of the economics of these large-scale utility-scale projects. And then finally, right in the middle of the chart, you can see there are very genuine concerns as they relate to financing. Again, we on one hand, we've seen the Treasury actually has reduced the long-term interest rates, but on the other hand, we've also heard of instances where financing has gotten a little more problematic, especially for smaller projects or for new players that are entering into the market. So there are again implications in terms of what happens to projects if cost of capital continues to go up and or the actual financing pool itself starts to shrink. And then finally, for wave 3, there are some, again, implicit and explicit implications of COVID-19 that could, impact RFPs. There might be some delays right away, or in some instances, again, utilities that have started to see some reduction in demand because of COVID-19 might either shelve or at the very least delay some of their, RFP filings or procurement filings. So there's definitely a little bit of downside to long-term utility scale solar PV procurement. So now that we have the bad news past us, let me start to talk about some of the positives, right? So again, as I said, once we look past 2020, we do believe that for the US market, the solar fundamentals are fairly strong. Starting off with the residential solar segment, I'll go from top left corner and go clockwise. So resiliency has become a key driver for solar, and in a lot of instances, solar plus storage installations in the residential segment. Most critically, what we've seen coming out of California, where the CPUC or the commission did actually impose requirements for electric utilities to shut down their power supplies during wildfire season if they anticipate any kind of wildfires impacting their electricity grid. So these are called public safety power shutoff, or PSPS. So while PSPS has been prevalent in California and has actually seen a pretty meaningful rise in customer interest in both standalone solar as well as residential solar plus storage. The implications of PSPS actually, interestingly enough, were not restricted to California. We've also heard of anecdotes from installers going as far out to Texas and even Florida, where consumers have actually mentioned PSPS as a potential reason to consider solar and solar plus storage in some instances. Even outside of PSPS, there are other weather events like hurricanes that we have seen in the southeast, to storms in the northeast, in states like New York, Massachusetts, Vermont, New Hampshire, that have piqued interest of residential customers to consider deploying solar plus storage. The other set of drivers that we think are going to result in a shift in how consumers think about residential solar and residential solar plus storage is through rate design changes. There are already several states that are looking at moving away from full retail rate net energy metering to some form of value of distributed energy resource, or VDER, tariff. I think that phrase VDER, or the term VDER, has been fairly popular in New York, which actually started off on the VDER tariff reform a few years back, and we are currently in the midst of implementation of VDER tariff in that state. Similarly, there are other states like California that is looking at moving away from NEM full retail rate NEM to what we are currently in the midst of NEM 2.0. And then while it was anticipated that the commission would be looking at NEM 3.0 policy making last year, that got pushed out to this year. And again, because of COVID, there's still some uncertainty on the timing of NEM 3.0. But from what we understand, that there should be some initiation of policy making on NEM 3.0 sometime in the summer of 2020. Then moving past retail rate design changes, there are significant number of states, increasingly significant number of municipalities, regional entities like cities that are implementing 100% clean energy or 100% renewable goals. The states that you can see highlighted in orange or having orange border around them have already passed 100% clean energy targets, which in some instances may not directly tie to growth in renewable in behind the meter renewables, but at least some instances we are starting to see, or we have also in the past seen with RPS goals having some kind of solar carve outs, and more specifically having some kind of distributed solar carve outs. Then finally, when talking about mandates, we cannot ignore the impact of the new solar home mandate that we saw in California that actually went into effect at the beginning of the year. As some of you may know, the mandate basically requires that every new home construction starting from Jan 1st, 2020 will have to include solar rooftop. Now, as I said, the law went into effect only the beginning of the year, so it's still early in the day in terms of how much impact it's going to have. But needless to say that there is a significant upside to how much residential solar installations we are going to see in California in the several years to come. And then, in addition to everything that I've talked about, even the absence of any kind of policy making or mandates, we are seeing growth of solar just on the basis of economics in several new geographies. Historically, we've never considered states like Midwest, and states in the Midwest like Illinois or Indiana, Michigan, or in the Southeast, states like Florida, or in the Southwest, states like Texas or Colorado, to be key residential solar markets. But now, as solar solar costs have continued to fall, a lot of these states are finally getting past the retail rate parity equilibrium or curve, and as a result of that, the economics in these states is putting these states in front and center of a lot of these solar installers, and we've seen significant sort of new entries in these states by a lot of the national players as well as some of the new regional players. Moving from residential drivers to C&I drivers, there's a lot of data in the text on the slide, but I want you all to focus primarily on what's going on with respect to the growth in the large C&I segment, along with the what is known as the community solar segment. So as you can see on the left, historically, the majority of the solar has come from small to medium C&I customers, with more than close to 60% of the growth coming from the small and medium C&I customers in the past. About a quarter of the growth has actually come historically from large C&I customers, and a little under 15% from community solar activities. But if you start to see the trend broken down by installation year on the right, you will notice that while the dark blue and the medium blue have historically been the major portion of the C&I segment, since 2016 or so, the majority of the growth actually has started to come from the orange bars, which are the community solar segment, and the gray bar, which is large C&I projects. that's relevant for the sort of the growth prospects for non-residential segment going forward, particularly if you think about what's happened in the community solar segment the last few years. Again, historically, states like Minnesota had represented the bulk of community solar growth in the early years. Now, as starting last year, starting 2019, we started to see New York actually also come into the fore and in community solar growth, again, as a result of what we saw with respect to clear value creation through the Value of Distributed Energy Resource Tariff, or the VDER tariff, that's applied to community solar markets in New York. Similarly, states like Massachusetts, New Jersey, Illinois, Maine are also currently implementing or already have implemented community solar programs within their states. So again, that's definitely a segment that we are tracking pretty closely, and we believe is going to be one of the growth engines for non-residential segment in the coming years. Going from residential to non-residential to now talk about utility scale procurements. Again, we'll go from top to bottom on the chart here. If you see 2016, RPS, which stands for Renewable Portfolio Standard, along with PERPA, which is somewhat of an archaic, although still relevant policy that was initiated by in 1970s, which basically requires utilities to go with the least cost alternative, or least cost solution, as long as the project sizes are under a certain threshold, have driven a lot of the growth in early half of 2010s to even the middle of 2010s. But in the last few years, you will see that the gray bar, which is right in the middle of the chart, from 2017 to 2019, has pretty much been over 50% of the overall utility scale segment. The gray bar stands for voluntary procurement, which in a very short way means that solar competing head to head against other generation assets. So a lot of the utilities, when they go out in the market to procure generation resources, have to do that in form of request for procurement or RFPs, which results in bids that come in, and the utilities have to obviously look at their load profiles, as well as their overall load shapes as well, and incorporate the right kind of generation mix that would help them meet those load growth forecasts. So solar, of course, cannot be at this point at least, cannot be the only resource that fills in that entire generation mix, but increasingly it has become the technology of choice, or generation technology of choice, because of the cost competitiveness of solar compared to some of the other generation assets. The other driver is shown in the green bar, is basically what we call as corporate procurement, or in essence, non-utility entities such as big commercial corporate companies like Google's and Microsoft's and Apple's of the world, that have increasingly taken to procuring off-site renewable assets through virtual PPAs or remote PPAs in order to basically fulfill their own on-site energy needs. Now, again, COVID-19 is obviously going to have a huge impact, and we believe it's going to be hitting the hardest on the prospects of future corporate procurements, and we'll get to that in just a bit. But for the time being, again, it's definitely one of the major drivers for the growth in utility scale solar. We did talk about how RPSs have shrunk in terms of their share of utility scale solar growth historically. But if you go back to one of my earlier slides where I talked about as much as 8 states and states and 2 territories have already have already sort of put in law renewable portfolio standards, 100% renewable portfolio standards, or 100% clean energy standards, I should say. We do expect that again in the middle of 2020s and beyond, the RPS portion of the market would start to grow again in those states, particularly as the utilities have to start procuring renewable resources in order to meet those mandates. The last sort of key driver that I want to touch upon that actually spans across all 3 segments is the growth of solar plus storage. Although, again, in the interest of time, I won't go into a lot of details on what we see in residential and non-residential solar plus storage markets. But what you see on the screen is the share of solar plus storage deployments in 2019. So about 7% of all solar that was installed last year in 2019 had energy storage attached to it. Of that, over half of it was actually solar storage that was concurrently built with solar, and about 40% of it was retrofitted or retroactively attached after a solar project completion. Now, a couple of things to keep in mind. This is again, just looking at 2019 picture. If we zoom past 2019 and look at some of the current state of utility procurements again in several geographies, including Nevada, Colorado, California, Hawaii, Indiana, and I'm missing out at least half a dozen other states. But increasingly, a lot of electric utilities are procuring or at least putting the option of adding storage in addition to solar. The reasons for that, of course, is the fact that with again the increasing penetration or increasing sort of amount of solar in the resource mix gives you a certain kind of generation curve, which obviously peaks in the middle of the day, which may or may not always tie. In fact, typically doesn't tie with the typical load profile that we see in those geographies, in pretty much all geographies again, as load tends to peak sometime in the evening. So now adding 4, 5, 6 hours of storage, which is what typical storage duration ranges are, you could essentially shift the middle of the day solar output and push it to evening hours, and thereby provide a more flexible and some sort of less intermittent generation profile to your resource mix. So again, given all these drivers in mind, let me just quickly walk you through our 5-year outlook. For the residential segment, we again, as I started off at the beginning of the presentation, 2020 is going to be a hard year. It's going to be a hard year because, again, reduction in consumer spending, unemployment levels that especially amongst, of course, on across the generic, the general population, but also across some of the key demographics that typically install solar. We do expect that, about 25% reduction to residential solar volumes compared to 2019. That volume will start to pick up again in 2021 as consumer spending starts to pick up again, and then we go past pre-COVID levels by sometime only 2022. Now the ITC step down, of course, is adds another king to the whole process because the ITC step down actually for residential customers, for customer-owned residential installations, happens in 2022, which does complicate some of the recovery efforts. Now, there would still be ITC eligibility of 10% for third-party owned systems, and that may result in a shift in terms of how third-party owned systems perform compared to direct customer-owned systems in the post-ITC world. But a point here being that, again, if we go past 2023, we again start to see the growth resuming to levels that we haven't seen so far, especially as some of the emerging markets like Texas, Florida, Colorado, Virginia start to take up more share of the future installations. Now, again, the long-term growth that we are projecting here is highly contingent upon a few factors. One of them is just stability around the regulatory frameworks, i.e., existence of net energy metering policies. Similarly, in markets where we started to see a huge uptake in residential solar plus storage projects, technology and business model innovations that basically tie not just residential solar but also solar plus storage projects would basically impact the growth trajectory or growth prospects in the mid 2020s. Again, we do see the market reaching about 4 gigawatts of annual installations by 2025. From residential to now looking at non-residential solar, very similar story in terms of the shape of the curve, but the actual recovery is a bit prolongated, as you can see, where we get to pre-COVID levels of 1.5 gigawatts or so only by 2024. So we do see a 50% drop in installations in this calendar year, and some of that drop would actually spill over into 2021 as well. Now, unlike residential, the CNI segment would continue to enjoy ITC 10% credit even for directly owned systems, but on the biggest sort of downside to our growth story again is as companies start to transition into what we are calling the new normal, they are not necessarily going to prioritize solar purchases right off the bat. So we do expect to see a little bit of pushback with respect to CNI's solar origination in the coming years, and we only get to sort of as I said, 2019 or pre-COVID levels by 2024. Now, similar to what I mentioned in the residential solar segment story, the prospects of CNI solar plus storage also hang pretty heavily on the growth story that we're presenting here, especially in markets again like Massachusetts and New York, where there are specific tariff structures that encourage solar plus storage projects in form of adders that are starting to see traction with respect to non-residential customers. And finally, the utility scale segment is sort of the poster child at this point, at least for the year 2020. That in spite of COVID hitting us strong, we are expecting that we are going to see 14.4 gigawatts of installations in this calendar year. Making it the biggest year we have seen ever in the history of solar. But that's again tied to a few different factors. One of them is just the ITC step down from 30% to 26% this year, going on to 22% the following year. So we should expect to see some kind of temporary slowdown in procurement from the utilities and other off-takers by 2022, and developers actually start to focus on making sure those projects meet the 2023 deadline to capture the higher ITC levels. So as a result of that, we expect that the contracted pipeline is going to hit its peak sometime in 2022, and the installations are going to actually hit a peak in 2021, and then get to about 13.5 or 14 gigawatts of annual volume for the next several years. And a lot of that growth actually is going to be driven not just by utility scale procurement, but in the outer years, as I said a few minutes back, CNI growth, CNI based demand is also going to drive some of that growth. So in conclusion, I want to sort of leave you all with how our story or how our view of US solar market has changed just in the past 4 months. The dark blue lines on all three charts represent our pre-COVID view, and as you can see, there's a huge dip in both the residential and non-residential segment in years 2020 and 2021 before we get to some kind of normalcy past 2022 and beyond. The utility scale segment actually is operating in a very different way, where actually we have increased their forecast slightly for 2021 and 2022. Some of that actually is driven by the urgency that we've seen from utilities in procuring solar, while the ITC or the investment tax credit levels are still high. But if you look past 2021, our forecast is more or less, a few hundred megawatts, a bit lower, and as a result of which, our sort of net change in a forecast for the utility scale segment from 2020 to 2025 is about down by about 500 megawatts, or little under 1%. The residential forecast actually has the biggest drop on a cumulative basis. We are projecting about 11% drop in our residential forecast from 2020 through 2025 on a cumulative basis. And the non-residential segment falls somewhere in the middle with about 5% cumulative reduction in 2020 through 2025 installations. So with that, I'm happy to take questions.
Thank you, Ravi, for a very insightful presentation. I think we have gathered quite a lot of interesting information, and indeed something to discuss in the next few minutes. We have some time for some questions. I would like to kick off the discussion and the Q&A with a clarification that has been asked by an attendee. What's your definition of community solar? And if I may build on that, do you think it's going to continue to be one important segment in or component of the non-residential segment in the future?
Absolutely. So community solar programs are basically programs where third parties, or in some instances even some utilities, can install larger scale offsite projects and have subscribers subscribe to a portion of electricity from the overall project. Typically, we have seen that the subscribers, are a mix of residential and non-residential customers. Typically, as much as 70 to 80% of the actual offtake usually comes from the CNI subscribers. Some are in some markets, or some projects have one or two very large anchor tenants, and then about the remaining 15, 20, 30% can be made up of several hundred or several thousand residential customers. So community solar basically is a vehicle that was launched about 6 to 7 years back as a means to allow for behind the meter customers to access solar in instances where they don't either have leasing rights to install solar on their own rooftops, or for residential customers are living in homes or buildings that cannot have solar because either they're multifamily homes or apartment complexes, or may have shading issues because of which they may not be able to get a full sort of economic value of deploying rooftop solar. To answer the second part of the question, yes, we do believe that community solar is going to be one of the biggest drivers of non-residential segment in the future. As I mentioned, as of today, there are only a handful of states that meaningfully contribute to community solar market installations. Minnesota and New York being the top two from the historical sort of standpoint. Increasingly, we are seeing several states implementing their own community solar programs. I mentioned a few in the presentation. New Jersey is rolling out a community solar program as we speak. Massachusetts already has a community solar adder as part of their smart program initiative. Similarly, Maine very recently, along with passing 100% clean energy standard, also pushed for or also added a community solar target or goal for the state. So there are increasing number of states that are introducing community solar programs within their jurisdictions.
Thanks for the explanation. We have a question that targets the elections in November. Do you think it's potentially a game changer? So what would you be in your view the effect of a Democrat in the White House? What's the impact on the solar industry?
Yeah. So a couple of things here, right? US, as some of you may know, it has a sort of federalist view towards how policies are made. What I mean by that is at the sort of federal level or the country level, there are only certain policies that can be enacted, whereas the states have the liberty to basically roll out their own set of policies, whether it's on the energy side in form of RPS or renewable portfolio standards, or having renewable energy certificate programs. So there's definitely a sort of a lot of flexibility in terms of the policy making that states have on their own, even in the absence of any kind of federal program. Which means that irrespective of who wins the 2020 elections, because of the state programs that we've sort of highlighted in the presentation, and some others that are currently sort of under discussion in other states, we do believe that the picture that we provided actually is sort of reflective of more so of the state programs, along with the current ITC step down baked into it. Now, if we were to get a Democrat in the White House, there's definitely a huge upside. Now, that huge upside could materialize in a few different ways, right? First of all, ITC extension could be back on the cards. Although there, because of COVID-19, there have already been significant efforts from a lot of the advocacy groups. And I know Abby actually was supposed to speak on the session, who couldn't make it, who leads SIA, and SIA has done a lot of sort of advocacy work in the country to promote for ITC extension. And we do have some Senate support for that as well. Now getting a Democrat in the House could definitely change the picture and provide a more forceful sort of approval to an ITC extension. And then finally, the last piece to that is any kind of federal level or national climate action, whether it is in form of clean peak standard, which or clean clean target CPP that was initially proposed by the previous administration, or any kind of other sort of federal level policies on carbon could again have a positive impact, assuming or in case we do get a Democrat in the White House. Rafael, you're on mute. I can't hear you.
Apologies, I pressed the wrong button. Yes, thanks. Okazan, from my side, I think you mentioned different US states. You talked about California, Massachusetts, plus emerging markets that are coming up. Which states, in your view, will lead the growth in the next years?
Yeah, great question. So I think the answer to that question, we can sort of split the discussion into the three segments again for sort of sake of clarity. For the residential segment, California, for the foreseeable future will be the largest market, because of sort of fairly progressive energy goals. In addition to the fact that retail rates typically are higher in California, so the economics it works in favor of consumers if they deploy solar. And then finally, we briefly touched upon this, the new solar home mandate, which basically requires all new homes to have solar on their roofs, right? So these combination of these sort of economic and policy factors is going to sort of keep California in the mix for the foreseeable future. Now, there's definitely a little bit of downside to that too, in terms of what happens with respect to the net energy metering reform that should be taken up by the CPUC later this year. Going past California, I think there are several sort of tier 1 states that will continue to grow, like New York, like Massachusetts. But I think what we are more excited about is sort of the growth prospects in some of the emerging states like Texas, Florida, Virginia. So just to give you some sense that these states in Q1 of 2020 recorded the highest level of installations we've ever seen from these states. And again, Q1 tends to be typically a down quarter for residential installations, but it was promising to see that all these states that I mentioned broke their own previous records for quarterly residential installations. So we definitely have see these few states in the Southwest and the Southeast that are going to sort of are going to continue to be promising just on the basis of superior economics. Now, for non-residential, we touched upon this, so I'll skip through it. but just sort of reiterating that community solar programs are going to be some of the key drivers for the C&I market, and the states that I mentioned have fairly robust community solar programs are going to sort of lead the way in that segment. Now, coming to the utility scale, this is where we see sort of the biggest amount of diversification in terms of states. Again, historically, California, as well as some of the other Southwest states, were, had the biggest sort of market share of the utility scale segment. Now, increasingly, we're starting to see a lot of other states, even in the Midwest, in the MISO territory, as well as states in the Southwest, like Virginia. Well, Southwest is Virginia, not in Southwest, but Southwest and Southeast, like Virginia, Texas, Florida, again, states that are increasingly seeing, sort of solar compete head to head against other forms of generation asset on an LCOE basis, are definitely looking promising.
Thanks. One more question. You mentioned and you described briefly what's the California ruling on new houses, so mandatory solar for new build houses. What have you seen so far in the first 2 quarters? It's maybe too early to tell, but has it been working? And do you think it's going to be replicated in other US states at some point?
Got it. So I think, like you correctly said, it's very early to talk about the sort of quantitative impact of new solar home mandate, especially as home sales have actually started to slow down again through the end of Q1 through now, because of again COVID impact. But I think we project that this year onwards, we should start to see single percent increase in actual new installations coming directly from the new solar home mandate, and by 2023-2024 timeframe, as much as 20 to 25% of annual residential installations in California will be tied to new solar homes. So we are talking about a few hundred megawatts being added to residential segment on an annual basis in the next couple of years and going forward.
Great.
Oh, and the second part of the question.
Yes, please.
I think at this point, it's again very early to say which other states are sort of next in the queue to implement a new solar home mandate. However, we have seen Massachusetts, for instance, at least start to look at new solar home requirements as a policy tool. It was introduced in one of the bills last year, but I don't think it went anywhere. But at least it's a start. Once we start to see new solar home being sort of included in some kind of bills at state legislature, it usually is a sign that with again the right kind of consensus and right kind of support behind it, it usually takes 2 to 3 years for those policies to actually get in place.
Great, thanks a lot. I see that we're a bit ahead of next, so we exceeded a bit the 4 p.m. deadline. I maybe take the last question from the audience, which is about big data companies. You talked about that. You talked about the Microsoft, the Amazons, the Apples, and their commitment to go renewables for their data warehouses. What is their commitment? Have they all set 100% renewable target? How do you think this evolves in the future?
Yeah, great question. So if you look at the CDP data, a lot of the big data companies have, put fairly aggressive 100% or close to 100% renewable targets. What's sort of interesting in our view is, at this point, it's a given that these big data companies are going to procure solar, right? And a lot of them actually already have. So if you think about Amazon, it I think already has met that 100% goal for itself. Apple is also either close to it, already has accomplished it. So I think a lot of those companies have already accounted for, right? The next wave of corporate solar procurements is not necessarily going to come just from these bigger companies, but I think we start to go past the Fortune 30, Fortune 50 companies and actually look at the Fortune 250 companies. Those are going to be sort of the next wave of big corporate procurements. Now again, given COVID, some of that might slow down, but if we go past 2022, 2023 scenario, again, we do expect to see growth coming coming from those companies. Now, coming back to Apples and Googles of the world, I think what is promising from their standpoint is not just procuring more renewables, but actually putting their sort of efforts behind making sure that the load curves follow the renewables, right? I think you may have seen Google recently talked about a particular data center that actually makes sort of real-time decisions on how much data to process or how much energy to consume based on the available generation. So that could be done obviously by shifting load or by adding storage. So we are definitely getting into the paradigm where some of these bigger companies are going to look at not just getting 100% renewables, but also making sure that they're getting 100% renewables to match their load needs on a timely basis.
Great. Yes, indeed. Sounds very exciting, and I think it gives a positive closing to our session today. So thank you very much for sharing your expert view on the solar market. I think we have learned quite many interesting things today, and I look forward to seeing what awaits us in the next years. So I would like to close it here. Many thanks to all the attendees for the questions and for joining us in this session. Just a side note, tomorrow we continue with the overview of the most active markets around the world with a focus on the Middle East and Europe. So we include a presentation from the Middle East Solar Industry Association, MESIA. And we also have an exciting panel with representative of Solar Association from the most active EU markets. That's it from my side. So thanks again, and I wish you a very pleasant rest of the day and looking forward to seeing you tomorrow. Goodbye.